Good evening and welcome to our February Investor Webinar brought to you by focusIR and London South East. For those of you who don't know me, I'm Donald Leggett, Head of IR Media, and I'm your host for this evening. We're delighted to welcome three excellent companies tonight, each with considerable growth potential, and a resource analyst will talk investors through the investment potential of the uranium cycle. The first of our speakers is Sapan Ghai, Chief Commercial Officer at Sovereign Metals. Sovereign are developing the world's largest titanium dioxide deposit, as well as a large flake graphite deposit. Our next speaker tonight is Will Holland, CEO at Europa Oil Gas. Europa has just bought into a high-impact gas project in Equatorial Guinea, where the discovery well has a 91% chance of success when drilled. Our third speakers, I should say, this evening are the senior team from MicroSalt plc, Rick Guiney, CEO, and Konrad Dawbrowski, CFO. And they're the first company to IPO name this year. Do you hold shares in MicroSalt? Please tell us yes or no. And our fourth slot is taken by Gaius King, resources analyst at Fox-Davies Capital, who will talk investors through the uranium cycle. Last year, uranium rose in value by 100% before falling back slightly, and available supply is now forecast to be just 72% of demand. Each presenter will speak to slides for up to 20 minutes before taking live questions. Some brief housekeeping points for you. You may have noticed we've rebranded. focusIR as London South East's new digital investor relations arm. We continue to distribute our content on London South East, of course, and more recently on Research Tree and Armchair Trader, amongst others. As ever, many thanks for joining us tonight, and it's time to hear from our four speakers. ASX and AIM-listed Sovereign Metals are focused on developing a Tier 1 long-life titanium dioxide and graphite operation in Malawi, Southeast Africa. In September 2023, Sovereign published a pre-feasibility study which confirmed CSIRO's potential to be one of the world's largest and lowest cost producers of both titanium dioxide or rutile and flake graphite. Titanium dioxide has many industrial uses, aerospace, paint, and graphite is the largest single component of electric car batteries. Mining giant Rio Tinto is the world's largest producer of titanium slag, and Rio partnered with Sovereign last year, paying 40 million Aussie dollars for a 15% stake in the company. Sapan Ghai, Chief Commercial Officer at Sovereign Metals, joins us now. Welcome, Sapan.
So thanks for the summary, Donald. It means I can run through these slides a little quicker and get to the Q&A, which is the more fun part, I always find. Hopefully everyone can see our front page here. This is our February investor presentation. I wonder how many viewers, listeners come across companies who can boast that they are targeting to become the world's largest of anything, the world's lowest cost of anything, and doing so at the lowest emissions possible. And that's exactly what Sovereign Metals intends to do within two critical minerals, those being rutile, which is the highest grade naturally found titanium oxide, and graphite, which ends up in your lithium-ion batteries. The usual disclaimers apply. We are ASX and AIM listed, so we conform to the regulatory requirements of the ASX. First things first, what do we have? We are 100% owner of the CSIRO rutile graphite project in Malawi. It's a genuine greenfields discovery. We discovered it in 2019. We were looking for graphite in the country. We found a nice small graphite project, which we took to PFS. While we were looking at that project, we ended up tripping over CSIRO. The world's largest rutile deposit ever found, the world's second largest graphite resource. It's the first rutile dominant deposit found in over 70 years, which is probably why you haven't had many companies come and talk to you about rutile. It's a blanket style mineralization from surface. What does that mean? Think of your usual sponge cake that you can buy from your local Tesco's. And think of CSIRO as the icing on the cake. That's essentially what it is. This is not hard rock. And in the bottom left-hand side of this slide, you can see a picture of one of my colleagues who has just essentially crushed the ore in their hands. It's not hard rock. It doesn't need crushing, grinding, and all the blasting, drilling, and all the usual bits of mining kit that a normal mine would require. Importantly, the rutile and graphite sit as liberated minerals within that structure itself. So they're not chemically bonded in any way. We don't need to reverse geology. We simply get rid of the 98% of stuff we don't need and intend to sell the 2% of stuff that we're focused on. In September 2023, we announced the conclusions of a pre-feasibility study. That pre-feasibility study really put us into a tier 1 category. The sheer scale of CSIR can be seen in these numbers, with a post-tax NPV of $1.6 billion US, an average annual EBITDA of over $400 million US per year for 25 years. And importantly, at the end of those 25 years, we'd have only mined 30% of the known resource. So this thing is, generational. It could go on for 50, 60, 70 years quite easily. I think I'm telepathically hearing a lot of people saying, what on earth is rutile? Now, rutile is essentially the highest grade form of titanium dioxide. Titanium is a critical mineral for the US, for the EU, for Japan, simply because it's used in a plethora of industries due to its high strength, its low weight, it's corrosion resistant, it's temperature resistant, it's biocompatible, which means it can be used in all sorts of products such as cosmetics and food and toiletries. Now, about 90% of titanium enters the market as titanium dioxide, TiO2. And that essentially is a white pigment that ends up in paints, in cosmetics, in plastics, paper. 7% of titanium will end up as the metal. So that becomes your new Apple iPhone, all the way through to the landing gears of your Boeings, your Rolls-Royce engines that help us fly around the world, and obviously a bunch of medical uses such as artificial joints. And specifically for rutile, as part of the rutile market or rutile production ends up as electrode fluxes within the welding space. So very important for construction, for manufacturing and infrastructure. As long as we are wanting to put two sheets of metal together, we'll be needing rutile. As I said, rutile is the highest purity titanium mineral. Now, titanium itself is not a scarce metal. Indeed, if you decided to poke 3 or 4 holes in your backyard, if you're lucky enough to have one, you'd probably end up with some titanium in there. It's the 9th most abundant element in the Earth's crust. However, commercially mineable and commercially viable and usable titanium is a different story. And that usually comes in 2 forms: ilmenite, which is a more commonly found oxide of titanium, and rutile, which is what we have discovered with Sovereign. TiO2, which is the titanium dioxide component, and therefore really, I would say, the commercially viable component of these 2 minerals varies significantly. Ilmenite has a TiO2 grade of anywhere between 30 to 60%. Rutile is near enough pure TiO2 at around 95% grade or above. And that's really reflected in the prices of the 2 minerals, with ilmenite usually trading anywhere between $250 to $400 a ton. Rutile currently getting prices for well over $2,000 a ton. So very different markets. Why is that? Well, if I wanted to, once I had mined ilmenite and I wanted to use that in high-grade feedstock, so good quality paint, good quality titanium metal, I would have to upgrade that using very costly, very capex intensive, very carbon intensive, energy intensive processes, smelting or roasting the ilmenite to a form that is usable by the end users in the titanium space. Now, those two forms are usually titania slag or synthetic rutile, neither of which still get to the 95% that pure natural rutile finds itself at. So rutile is so great, why don't we use just rutile? Simply put, there just isn't enough rutile on the planet. Rutile supply has been suffering from depleting reserves and lowering grades for quite some time. Over the last 10 years, about 250,000 tons of rutile have already come out of the market. We expect that another 250,000 tons, or 50-odd% of the rutile market, to vanish in the coming years, and that's on the back of the demand for titanium feedstock increasing at 3% per annum. So really a critical mineral which is absolutely short of supply. Rutile plays quite a critical role in decarbonization. Now, this is quite important. So rutile is direct feedstock. We dig it up, we liberate it from everything else, and we can sell that to the titanium industry, who can use it immediately, whether they want to produce the metal, the pigments, etc. Ilmenite, as I said, has to go through this process to become a synthetic version of rutile. That process, we have determined, produces anywhere between 2 to 3.3 tons of CO2 emissions. Compare that to digging up the rutile and selling that at 0.1 tons of CO2 emissions. That's almost a 97% reduction in CO2 emissions. Is that a nice to have? Yes. Is it critical to have? Very much so. Why? Well, when you look at your scope 3 emissions, or what ends up as a consumer product, here we've looked at a tin of paint. And if you're using synthetic rutile to produce your pigment that goes into your tin of paint at your local DIY store, you're looking at 7.7 tons of CO2 emissions before it gets there. Using natural rutile from cassia, you're looking at nearly half of that, at 4 tons of CO2 for every ton of pigment used. Why is that important? Well, look, the world is really moving that way. A regulation is driving industry to lower supply chain carbon footprints. On this slide, we've just got a collection of some blue chip names who have all committed to reducing the CO2 or the carbon emissions footprint of their supply chain. What's easier than substituting out your high CO2 emissions titanium dioxide for very low CO2 emissions rutile from our project? Rutile is only half the story. We are also the second largest graphite resource in the world. We would be the largest graphite producer once up and running. Graphite makes up about half of a lithium-ion battery. That space is really dominated by China, who are making noises in terms of calling graphite exports national security, and restricting those exports of graphite to places like the US and Japan and South Korea. We all know about lithium-ion batteries, how they're going to end up in electric vehicles, which will help us decarbonize humanity's carbon footprint. But on the left-hand side, you see here, graphite is actually about a third of the carbon footprint of an electric vehicle battery. What better way to reduce that significantly than to take out the Chinese synthetic graphite for cassia's graphite, which would be a 99% reduction in CO2 emissions to produce that graphite component of those batteries. Here's a chart that mining analysts love to look at. It's a production cost curve. Essentially, for the non-mining analyst, the lower your column or lower your bar in this chart, the lower your costs, your OPEX, and the wider your bar, the larger your production. We sit right at the bottom end. We are the lowest. We would be the lowest cost producer in the graphite space, and we are the widest bar there as well. So we would be the largest producer within the graphite space. What does that mean? It means when graphite prices are good, our margins are better than anyone else. It means when graphite prices are bad, everyone else has to go bust before it ever affects us. Now, how do we get the rutile and graphite out of the ore at CASIA? It's a very simple flow sheet. There's no new tech, high tech in this. There's no uses of acids and pyro. This is all very simple gravity separation using the physical properties of the rutile, which is a dense mineral, and the graphite, which is a much lighter mineral. Here in the top left in our facility within Malawi, we are using shaking tables to demonstrate just that. A shaking table is effectively a bench scale version of a gravity separation spiral. On here, we feed the ore, which has mixed with water, down the shaking table. You can see the dark rutile coming off here, and this stream here is the graphite. It's really that simple. Now, Malawi, many of you may know Malawi as a landlocked country in southeastern Africa. How do we get 500,000 tons of product out of Malawi and onto a boat so we can sell it to the big wide world? Well, we have this USP called the Nacala Logistics Corridor. What is that? That's essentially a railway that connects CASIA. In fact, the railway corridor goes over the southern tip of CASIA, of the actual mineralized area, and goes all the way out to the Nacala port in Mozambique. Based on our PFS, we had numbers that it would cost us about $100 a ton of product to get from our mine onto a boat, onto a vessel at Nacala, ready to be shipped anywhere in the world. Now, when you're selling a product that's almost $2,000 a ton today, you can swallow those type of logistics costs. Very quickly on Rio Tinto. So Rio Tinto made an initial investment into Sovereign Metals at Topco. So they hold 15% of the listed stock. They invested $40 million for the privilege. That $40 million will be used to advance our DFS, which we intend to kick off mid-year this year. Between now and then, they have an option to acquire another 4.99% by the end of July 2024 at a 10% premium to where they came in at previously, or 28p. We're currently trading at 23.5p. Why are they capped at 19.99% in total? Well, above that, they would have to make a mandatory bid for the entire company. Rio Tinto, what do they bring? A lot of IP, a lot of expertise and experience within the titanium industry, a lot of value chains and supply chains into the battery minerals sector. Importantly for us, they form part of our technical committee. They will help us qualify our graphite for lithium-ion batteries. And if we go into looking at any development finance, they will help us negotiate arrangements for that as well. Now, Rio have what is known as an option to become operator of the project 180 days post Sovereign announcing a DFS. Along with that, they get the marketing rights to 40% of the product. If they elect not to take up that option, they become a plain and simple shareholder like anyone else on the register. Touched on this already. Why is Rio interested in Sovereign? World's largest titanium slag producer, already has existing operations, including within Africa, and has set up a battery minerals division which they will use to secure supply chains for battery and low carbon materials for their customers, the likes of which are BMW, Ford, and Volvo. A little bit on Malawi. It is a member of the Commonwealth. English is the legal language, so it makes life a lot easier for us Londoners to navigate the legal system there. It's attracting a fair amount of foreign direct investment now, especially with Rio Tinto's investment. It was applauded as a milestone by the mines department there. Mining is part of Malawi's economic development strategy. Along with agriculture and tourism, it creates those three pillars, the three key focus industries that will help Malawi become a self-sustainable country, which is the aim here. You can't operate as a mining company in or as a global mining company, never mind a tier one project mining company anywhere in the world without really having a good framework, looking after local communities and having local support. We're no different. We have a lot of community and stakeholder engagement. We have done so for many years. We are promoting education within Malawi through a number of scholarship programs and school upgrade programs. And look, we have a very diverse workforce with over 80 individuals within Sovereign being Malawian nationals. And of those, at least 30% of those are women. These numbers on the left-hand side in terms of our share price, etc., are from the 31st of January, funnily enough. That 23.5p is where we finished up today as well. So they're very relevant numbers. We're trading at £132 million market cap versus our 1.6 billion MPV. So that gives you a bit of a feel of the disconnect between intrinsic value of our project and where we're trading in terms of our share price. Very quickly on the team, highly experienced. We've all either built, funded, financed projects across Africa, across commodities, across jurisdictions, worked for the majors, worked alongside the majors, worked within financial institutions that have worked on tier one projects in the past. So this is very much bread and butter for this team. And I think with that, I think we should move on to Q&A.
Okay, thank you very much indeed, Sapan. So let me step in and ask you, is it unusual to find two world-class discoveries in such close proximity?
Everything about this is project is unusual, I would say. You know, it was the first rutile discovery in 70 years. Rutile is usually found as a byproduct of within ilmenite projects, apart from one other project, which was the Sierra Rutile project in Sierra Leone. And more often than not, you never find them alongside graphite. So yeah, this is not, and this is an important point, this is not a rutile project and a graphite project. This is both rutile and graphite within the same ore body.
I didn't realise it was so easy to actually separate the two. Could you talk us through that a little bit more? And commercially, how advantageous is the fact that it's so easy?
Sure. Look, go on our social media feeds and you'll find lots of videos of those shaking tables, as well as other parts of our lab, where we show just how easy it is to liberate these products. I mean, really, it's as simple as it's not hard rock. So the titanium portion and the graphite portion are not combined with other minerals and intercorrelated with other minerals, where we need to break them down and redefine the geology of this deposit. It's simply as easy as washing out the parts that we don't need, which leaves us with the parts that we would like.
Talk us through, you mentioned briefly the discovery. You sort of stumbled across it, you said, which is a story in itself, I think. So you were looking for a smaller scale graphite discovery, and somehow came across rutile and graphite. So tell us a wee bit more about that. You have been operating in Malawi for a good 10 years now, so you're very well embedded there, and you've got very strong government links. So talk us around all those things.
Sure. So you're right. Sovereign Metals, since 2012, had been looking for graphite in Malawi. That ended up in us finding a deposit called the Malingundi Graphite Project, which we took from discovery all the way through a scoping resource, scoping study, reserve, and a PFS, a pre-feasibility study, which came out in 2018. We were moving that project to a definitive feasibility study, and as part of that, we were doing a lot of bulk test work on the graphite. So we have a lot of innate knowledge on graphite, and specifically the flake graphite that's found in Malawi. While we were producing graphite at lab level from Malingundi, we kept finding titanium within the waste material. So then we asked the question, well, why is there titanium there? Because normally you find these titanium deposits in and around coastlines when they're coming up with such high concentrations. So what we did was look back at 125 historic drill holes, and we found titanium signatures in each and every single one of them. So then the question was, obviously, is this rutile or is it ilmenite? What form of titanium does this take? Because if it's ilmenite, maybe it's a nice byproduct. If it's rutile, this is something that's really going to be a company changer. Turns out it's rutile. So the next question is it commercially viable rutile? Because a lot of the time, these titanium oxide projects fall by the wayside because the chemistry set within which those oxides belong make it commercially non-viable. You can't produce the end product because there's too much alumina, too much uranium, thorium, too much chromium in there, too much iron. We had none of those problems. This was totally commercially viable. So then we spent the best part of a few years trying to figure out just how much of it do we have. And turns out we have more than anyone else has ever found on the face of the planet.
Okay, and you've linked up with Rio Tinto, which is quite a thing in itself. To what extent? You mentioned a couple of ways that Rio Tinto are able to assist Sovereign. Let's talk about the definitive feasibility study. You said mid 2024 that's coming up. In what ways will Rio Tinto be useful to you?
Yeah, so what we're doing right now is the PFS numbers that I had shown, that $1.6 billion, the $415 million of EBITDA, 25 years mine life, or initial mine life, I should say. That's all based on Sovereign standalone. There was no input from Rio Tinto into those numbers. What we're doing now is pulling apart each and all those assumptions that we made to produce that study, and looking at those through the lens of a Rio Tinto with all the expertise and experience they have from everything from mining titanium oxide minerals through to tailings management, through to water management, and seeing what their IP, what their tech expertise can bring to the table. That will inform us of what a DFS should really concentrate on. And how we should scope out to DFS, and from there it's go.
Now they sit in your technical committee. I mean, is it an easy working relationship? How have you found it? At the end of the day, you're the minnows, and they're the mining major. How is it working out?
Yep, very much so. Look, it's working out very well. They have a number of employees who are full-time CASIA individuals, and these are not juniors. These are important individuals in their own right, with lots of experience and expertise of building mines in and around Africa. The way the technical committee works is you have 3 Sovereign individuals, you have 3 Rio individuals, but Sovereign essentially is chair and has the casting vote. So what does that mean? That means the DFS, when it comes out, will be a Sovereign DFS. It will be driven by us as a company. And if you spoke to Rio Tinto, I'm sure they would make the point that, look, at this stage, even though they are helping us in all these ways, they are very much a minority shareholder in the company, and an equity investor almost, and that's the way they see it.
Okay. Which takes us neatly to Martin Pickard, who asks a question, maybe not a straightforward question, but he says, how do you prevent a full takeover by Rio Tinto at a price that they determine, rather than obtaining the maximum value for current shareholders? I hope that's not too much of a curved ball, Sapan.
Well, look, whether it would be Rio Tinto or any other third party making any type of bids for a company, ultimately, the decision lies with the shareholders. So if the shareholders don't like a price, there's no deal to be done. This isn't, as a team, this isn't our first rodeo into M&A as well, and we will do the best to maximize value for our shareholders. Myself, I've worked on I forget the number of deals, but in terms of value, probably something close to $13 billion of M&A in the last 15 years. So been there, done that quite a bit. So we know how to ensure that our shareholders get the best value. But look, ultimately, what can we do as a team? It's worry less about where the share price is going and what the market is doing, and just advance the project forwards. And those are the exact steps that we are taking. And I think hopefully the market is seeing that in the numerous announcements we're now making into the market, and continue to make, and will continue to make over the course of the coming weeks and months.
That sounds very wise, Sapan. You mentioned a capex figure of 600 million to develop the Kasai mine earlier. Could you map out a pathway to production for investors for us, please?
Yeah, look, so when it comes to that capex number, it seems big when you compare it to your average mining project. This is not your average mining project. This is a tier one project. This belongs in discussions around billions of dollars, not millions of dollars. That $600 million is still only a third of the NPV. It's like 1.5 years worth of EBITDA once this thing is up and running. So a rutile project of this kind with a graphite byproduct, I see it as eminently financeable by any finance institution. What does that time period between now and production look like? We'll spend the best part of the next kind of 3 to 6 months doing that stripping of the PFS and putting it all together in an optimization, and moving on to the DFS mid-year this year. That'll take us about a year to complete and get us to an FID or a final investment decision. During that time, we'll obviously talk to everyone from the financing banks, the project finance banks, the IFIs, off-takers, because these are critical minerals and people do want to secure supply of both rutile and graphite out there, and you have seen off-take deals being done. So we see, if you talk about production, we see production conservatively 2028.
Okay, thank you so much for that last answer, Sapan. So that was Sapan Ghai from Sovereign Metals. Thank you very much indeed for joining us there. That is an absolutely fascinating project you've got there. So one for the watch list, I would say. I don't want to be bold, don't want to tell you what to do, but surely that's an interesting stock. Okay, and here we go. From one interesting stock to another. Welcome back, Will. You've been on a couple of times previously. Europa are AIM-listed. Europa Oil Gas has recently become a UK, Ireland and West Africa focused oil and gas exploration, development and production company. So a little bit of everything in there. Assets range from newly acquired gas exploration in Equatorial Guinea, a high-impact gas exploration well with 1.4 trillion cubic feet potential, close to existing infrastructure, which is what everyone is looking for, and 100% of the Inishkia West licence off the coast of Ireland, which has similarly huge gas potential and also close to the producing Corrib gas field. On both these projects, Europa are seeking a partner to drill a discovery well. Europa also hold various onshore UK gas and oil assets onshore UK. Here to discuss all these and more is CEO Will Holland.
Oh, good to be back. Thank you for having me again. And yes, it's been an exciting year. Actually, a lot's gone on since I last spoke to you. So I'd like to go through that quickly, and hopefully we can cover all the ground. Recognise don't have a huge amount of time. The disclaimer, first of all, London listed. We have to show that. I'll let people read that in their own time. And what is Europa Oil and Gas? Well, we are an oil and gas company. It says does what it says on the tin. We are a company that's got a number of different assets in various stages of their life cycle. We've got some onshore UK production, predominantly in the Rutile field, which is where most of our production comes from. We've got some development potential in that field as well. We'll talk a bit about that. And we've got some appraisal potential in both our Cloughton onshore UK gas field, but also in our Serenity offshore UK field. And then we've got these two, as you described, ILX fields. Sorry, am I coming through all right, Donald? Just sort of check. I can't hear you, but okay.
You want to?
I'm assuming that I am.
You're absolutely fine, Will. Absolutely fine.
Sorry.
On you go. We're enjoying you.
I just wanted to make sure I wasn't just talking to myself there. So.
Talking to the ether. No, you're talking to us.
Great. So yeah, we've also got these two very exciting. The term is ILX, infrastructure-led exploration opportunities. One in Ireland and one in Equatorial Guinea. And I'll focus a lot on those because they have a huge amount of potential to drive a lot of value with the business. So let me just go through those. First of all, here are our financials for the financial year end of 2023. They're a little bit out of date now, and we're putting our interims out. Our interim year end, or our mid-year is end of January, so we will have our interims coming out shortly. But our cash position as of November was 4.3 million. We're not looking to raise any money. We don't need to raise any money. Our current work program is all within our financial means. And that's a very important part for us to make sure we are operating within our financial means. Let's move on to Rutile first. Well, actually, let's look at onshore UK. So onshore UK, we've got a number of assets, 4 of them in production. From the slide you're looking at now, the ones with the green dot are the ones in production. But by far the largest is Rutile, and there's a zoom in sort of picture there that shows the Rutile oil field with the Broughton exploration prospect to the north of it. But just a little bit to the west of that is also Crosby Warren, which is also ours, and we operate that. But I'll talk a little bit about that, but I'm also going to talk a lot about Cloughton, which is our appraisal asset, which we are very excited by. Before I get onto that, Rutile, we announced our revised CPR numbers at the beginning of the year, showed significant upgrades to the old numbers, and we have a development program that we are planning with our partners, Egdon, to put to execute over the course of the next 12 months or so. We are waiting for our EA approvals. That's the main thing, and planning approvals. In the UK, that's one of the biggest hurdles you've got to get over to actually start operations. But there's plenty of running room here. The Ashover Grit, which we've got just under 500,000 barrels left to produce. We've already produced over 500,000 barrels. So we're going to carry on producing in that, but we're going to be targeting the Penistone Flags, which has got a significant resource, sort of double that, more than double that. So 2 million barrels equivalent. So what does that involve? Well, we need to expand the pad. We've got a pad in Rutile, and it's not big enough for the additional wells. So we need to increase the size of the pad. We're then going to drill these 2 wells, and we're going to connect a pipeline from the pad into a local gas grid. That requires a little bit of gas processing on site. And then a 600-meter or so pipeline to connect to the export route. So the we've done a lot of the engineering here. We know where we're going to put the wells. We know what this is all going to look like. We're now applying for all of the approvals that we need, and we've identified a rig, and we hope to execute this program as soon as we get the EA approval, which is going to be the end of this year. So that's exciting, very important cash flow for us. It keeps all the lights on. It not only does that, we generate additional free cash from this as well. And the field continues to perform above expectations. I will actually note that the ERC CPR, we're already above their P90 curve. Actually, we're almost above their P10 curve. But let me talk about Cloughton now, because Cloughton is something which we took over operatorship of at the middle of last year. Now, Cloughton is an onshore UK gas discovery. It's north of where the Wrestle field is. It's just to the south of the Yorkshire Moors. And it was drilled back in 86, and it made a discovery in 86, and it discovered gas. The gas didn't flow at commercial rates. It didn't flow at commercial rates for a number of reasons. It didn't flow at commercial rates, one, because the reservoir was quite tight, but also because the gas price was very low. When we looked at this, we did an asset assessment in the middle of the year and realized actually current operating environment, current completion techniques, current gas price, this is actually could be a potentially very material asset. 192 million billion cubic feet of gas is a lot of gas. It's equivalent to 32 million barrels, and that's in place. So recovery factors, gas you can recover normally more than you can recover from an oil field. So if we can recover 50% of that, we'll be recovering 16 million barrels of oil. So equivalent. It's obviously gas, but it's just to provide an equivalent number to oil. It's a material volume. So we think that's very exciting. We think it's a very valuable asset. We've just got to prove, can we flow the gas at the rate that we think we can flow? If we can, we're within a kilometre of an export route, and this is a very material appraisal well, because by proving we can flow at commercial rates would unlock what is clearly a very material resource. So we're excited by that, and looking forward to progressing that project over the course of this year. We also have Serenity, which is offshore. Now, Serenity was the appraisal well that we drilled a couple of years ago now, and it was disappointing, but we still have a discovery there in Serenity, and we're looking to monetize the discovery by tying back to the nearby infrastructure. There's a bit of work to do there. We really need to pick up an adjacent asset to make this work. So we're applying to the NSTA for an out-of-round application to do that. The NSTA is the regulator, and they are willing to entertain these discussions, and we will progress those discussions accordingly over the course of the year. But let's get on to the sort of high-impact stuff, the ILX I was telling about, infrastructure-led exploration. Now, why is this attractive? Infrastructure-led exploration is what all of the majors are looking for now in their exploration portfolio. It means that you can bring any discovery online quickly because it's close to existing infrastructure. Now, the key thing there is you need to be close to existing infrastructure that has capacity to take your product. Well, we certainly have this in Ireland. The Ireland, it is a discovery. Well, we've got the Corrib field offshore Ireland, which is the only indigenous source of gas in Ireland, which is connected to a gas terminal called the Ballineboy gas terminal. And that provides Ireland with about 20-25% of its gas. The rest of its gas it gets from the UK through an interconnector. We have the license adjacent to it. And if I move on to the next slide, you can see if you look at the slide in the top right-hand corner where it says east, next to that it says Corrib. That's the Corrib field. The white lines going down into the red is the wells going into the gas field in Corrib. You follow that horizon across to where it says Inishkay West at the top. You see there the Corrib sandstone label. That's the Inishkay West gas field, the gas prospect that we have. That's 18 kilometres away from the Corrib manifold. So it's a relatively easy and quick tieback to Corrib. And there's plenty of capacity in Corrib. Corrib is in decline, and we can tie that in relatively easily. Now, how big is it? 1.5 TCF of gas. That's the other thing which will be very attractive to a farminee, if it is a material side. But let's look at the supply and demand for Ireland. And this chart here shows the historic supply and demand for Ireland gas since the Kinsale gas field started producing back in the 70s. And there you can see the Corrib gas field coming on, and you can see that Corrib is in decline. And you can see also that the Blenheim terminal capacity, that it's got plenty of capacity in that terminal. And there overlaid is the Inishkay West if we have a discovery. So, and the grey part there is the imports from the UK. So sort of using a rough eye, we can see that we can be providing sort of through that manifold with Corrib and Inishkay together over 75% of Ireland's domestic gas requirements. So it's very material. Now, some people look at Ireland and they'll talk about the fact that they're no longer approving any exploration licensing. Well, that's licensing. The Irish honour the existing contracts, and we've just had an extension for our contract, for our licence. So we've had it extended by 2 years to the end of January 2026. So we've got 2 years to reprocess a seismic. We've already reprocessed it without getting too technical a couple of times, and that really improved the imaging. It reduced the risk around whether we were going to have a successful discovery, and we can do another step in that reprocessing, which should hopefully reduce the risk even further. And then we'll be looking to farm out and bring a partner in to drill the well for us and carry us 100%. Now, this would be a very material discovery for the company, and not only the company, it's a strategically important asset for Ireland. So moving on from Ireland, we go to Guinea. Now, it looks a bit of a departure from the UK and Ireland. Well, when I took over as CEO back in March of last year, we did a sort of strategic review of what we had and what assets we had, and how do we continue to add value? How do we look for really high impact opportunities which can really drive value and make a material impact on the share price? And one of the considerations for that is going into jurisdictions, one that we knew, where we have experience, but also into jurisdictions where it's a friendly operating environment, where you're welcomed, where you can do things quickly, where you don't have to wait a long time for the necessary approvals. And so when we looked at it with those lenses of where we have experience, where we like the geology, and where we like the operating environment, we ended up looking a lot in West Africa. And we used our existing contacts within West Africa to discuss opportunities, and we looked at a lot of opportunities. And this one really rose to the top. We really like this asset. And why did we like it? Well, it was infrastructure-led exploration again, but it's a different type of exploration. It's infrastructure-led. So I will quickly show you here. This is I've got another slide which will talk to you about how close it is to infrastructure. So let me talk to you about the technical side first. So this slide here shows a very significant brightening. This is called an AVO response. This is a seismic response which indicates gas. Now, you might hear other people talking about these type of responses. They can be very good indicators, but they can also be a bit not as clear-cut as you think. You have to have them calibrated. We know this is calibrated because it's the same play as the Chevron field to the south. It's the same response as the Chevron field to the south. And if I move on to the next slide, here you can see our prospects A, B, and C, which are those three prospects together are 1.5 TCF of gas on a P mean. And you see to the south, we've got this Chevron-operated field called Alain. We're 9 kilometers away from that. And we're 9 kilometers away from a pipeline which has got plenty of capacity and plenty of ullage as well. And that goes into the Bioko Island LNG terminal, which liquefies the gas and sends it into the global market, most of it going into Europe. So this calibrated response, because we know it's the same play and it's the same AVO response as the Chevron discovery, and there have been 8 exploration wells drilled on this play, and 7 of those 8 exploration wells have found commercial volumes of gas. All 8 of them found gas, but 1 of them was sub-commercial. The other 7 were all commercial. But with those sort of statistics, when we look that into what is that from a volumetric standpoint, what is that from a chance of success standpoint, we end up with, I said 1.5 TCF. I was over-egging it a bit. I'm sorry. It's actually 1.386 BCF, so just under 1.5 TCF, 9 kilometers away from exploration. Each one of those 3 prospects is a 60 to 70% chance of success. So when you run the statistics on that, we end up with a 91% chance that we're going to make a commercial discovery if we test all 3 of those prospects. That's world class. That's absolutely exceptional to get those types of chance of success so close to infrastructure. So we think when we to farm this out, it's a between $30 to $50 million well. So we're looking for a farming partner in order to drill this and test these prospects. So this is a summary. All of these slides will be on our website, by the way, after the presentation. So hopefully you can spend a bit more time going through the various bullet points yourself. I'm just hitting on the high points, but we really liked it because we think this will be very compelling for an operator to take over and farm into this. And they're already there and they're already very active. So we're very excited by that. We're about to start the farm out campaign within a short period of time. We're still going to look for new ventures. We're still going to carry on looking for new opportunities. It's still going to be in the same vein, things that we know, people we know, use our network, and within our financial capability. That's very important to us as well. There's a couple of others. I recognise I'm running out of time, I think, Donald. So there's a couple of other slides that's showing the Alain platform in Equatorial Guinea. And then the last one is a picture of myself and a couple of colleagues when we were having our TCM-OCM meeting in Malabo earlier this month, actually, with the Director of Hydrocarbons and a picture of an LNG tanker unloading LNG at the Bioko Island terminal. So with that, I'll wrap up.
Okay, well, thank you so much. That was terrific, really interesting. You've done such a lot. You've been in charge less than a year. So talk us through what you've actually achieved in less than a year, because what I'm hearing from that presentation is a lot of momentum. And I'm not sure there was so much momentum in the business before. So I think you should take a bow.
Well, thank you very much, Donald. Yeah, I mean, we've been busy. It's been a very busy year, we've done everything from helping. When we do work very closely with our partners in Wrestle, we do the reservoir engineering for them. So we're working very closely on optimizing the Wrestle production. We then took over operatorship of Cloughton in July. And we've worked up that opportunity. We've quantified the size of the prize, 192 BCF, which is equivalent to 32 million barrels. Then we picked up EG-08 in Equatorial Guinea in December, and then in January, just very recently, we had our extension for Island FEL 419. So it has been very busy, and that's how I like it, actually. And we will continue to do that, and we will continue to work up other opportunities as well as progressing the ones we've got very hard. So okay. Yes, I hope to maintain this momentum.
Yes, exactly. You've got to keep going now.
Yes.
Now, let me quickly take you to Penistone Flags. We've got Adam James, who's not seeing the momentum. He's thinking you could do better. He's looking for a planning application for the Penistone Flags and the 600 meters pipeline, something you said you would do well over a year ago. Let me put that to you.
Yes, and very valid point. Very valid point, and it has been quite disappointing at how long it's taken to get to this stage. The way the process works is that we have to go through this. The main application is the Environment Agency application. So typically what happens is you do a pre-application, you say, this is what we're going to apply for. Can you tell us if we've covered everything? And the EA will sit down and go through it, and they say, okay, you've come up with 17 reports. Actually, you think you've missed one, so go and add this report and then submit it on that basis. The problem is if you don't have all of the reports in the application, they can often reject your application. You've got to start again. So doing a pre-application prevents that from happening. Now, unfortunately, the EA are very busy, and we've been, with our partners, working very hard to try and attract their attention and get them to give us this pre-application meeting, which has now been scheduled, and we are going to have that meeting imminently. So on the back of that, they'll tell us everything which they expect us to do, and then we'll put the application in. So on that basis, and it should take about 6 to 9 months based on from once the application goes in before we would expect to receive the permit. So, we're hoping that we'll get that by the end of the year, and then we'll be straight into the operations.
Great. Okay, you were mentioning Cloughton, and having been overlooked for a while, you now see Cloughton as a really good prospect. You've just become operator, and you've just been given a license extension. So two points to note in terms of momentum. Richard Stabbins asks, the 1986 gas appraisal well was located more than 2 kilometres inside the Yorkshire National Park. Will the EOG be able to find a suitable well location near enough to the discovery for it to be commercial? And you were making the point that it needs to flow. And that's the big thing. It's got to flow sufficiently. So there you go. Yeah. Take us away.
I mean, it's a very good point. I mean, the original discovery well was drilled in the national park in '86 when you could do that. We're going through a stakeholder engagement process at the moment where we're talking to all of the stakeholders before we really start committing resources to drilling this well. I mean, when I say resources, I'm talking about doing the technical work to get the well drilled. We need to make sure that all of the stakeholders who need to approve it are on board with us. And the National Park Authority is one of those stakeholders. And we have engaged with them, and they're very happy for us to extract the resource from underneath the national park, but they don't want us to drill in the national park. So we've been looking for a suitable pad. Now, a lot of people will have heard me talk before, and they'll know that the largest landowner to the south is the Duchy of Lancaster, which is the King. Now, we've spoken to the Duchy of Lancaster, and they are receptive, and they haven't said no, but they've been quite slow. So we started to look for other alternatives, and we have found a number of other alternatives, and we've found a number of other landowners who are much more receptive, and we hope to be able to announce the results of those in the coming weeks, actually, when we've secured a suitable pad. Now, is it going to be optimally located to recover all of the resource in this structure? Maybe not as good as the original pad, but we still hope to access the vast majority of it, and it will be in an area which won't cause problems with local people. It will be an area which where we've got stakeholder engagement, where we know we're not going to receive issues from our various stakeholders there. So watch this space.
Okay, Equatorial Guinea. It's a fairly new addition. Why did it catch your eye? How did you find out about it? What are the next steps? What's the work program like going to be in the next year, I would have thought? And realistically, how long will it take to actually find a well partner if you want 100% carry?
Yeah. So, I mean, we found it through a very proactive process that we went through to using our network of looking at different hydrocarbon basins and identifying areas that we liked, and why did we like them from a subsurface standpoint, and then who do we know within those basins that we can approach directly and have a direct one-on-one negotiation with them. So it came through that process, and it came through our existing contacts. Why do we like it? We like it because we think a major will be all over this, and they will farm into it very readily. Now, you could ask the question, well, why did they not farm out to one of those majors right from the beginning? Well, the reason for that is because you had to, the data hadn't been acquired at the time. So you needed to be able to have a bit of a leap of faith with the people that you were dealing with And we'd all work with these people. So this is where it's really important to use your network of technical people where you know who they are and you trust them and you've worked with them in the past. The local team, the Antler team, have all worked with our team in the past at various different connections, from our chairman through to our G&G team. They knew them, and there was a lot of trust involved in that. We now have the data. We've worked the data up, so we know that it is as good as we expected it to be, and we're now preparing the data room to start the farming process. That's going to start imminently, and we hope to be able to farm it down within this year, and then hopefully we'll be drilling a well at the beginning of next year.
Okay. Sticking with Equatorial Guinea, Michael Isherwood, it wouldn't be a webinar without a question from Michael Isherwood. Thank you, Michael. He asks if there's scope to collaborate across the maritime border with Cameroon on the gas project in Equatorial Guinea.
Yeah, good. Dad Michael is pitching in. There is. Now, there's a bit of people that know the area will know there has been some problems in the past. There's a field called Yolanda to the south of ours, which spans both countries' licenses, jurisdictions, sorry. And but they're coming to a point where they think they might be able to unitize that. But we don't think it's necessary, actually. When we look at the Elaine field to the south of us, which we believe we've got an analog to, that doesn't go into Cameroon. It's just entirely within EG. We think we've got the same type of play, so we don't think it's necessary, actually. But if it does happen, nothing stops us from developing what's on the EG side. In fact, we could drill wells right up on the border and drain gas from the EG side if it did extend into that.
Okay, now my final question, and it must be a brief answer, I'm afraid. We are genuinely out of time. 30 hertz seismic studies is what you plan for Inishkea West. Now, Inishkea West, I suspect, is a fantastic opportunity, but it needs a little bit of a kick start. So why do you think this extra level of seismic is the answer?
It clarifies the subsurface. It improves the imaging of the subsurface. How much more will it improve it from the 20 hertz is yet to be determined. It may not be much, but again, it will just try to de-risks where the potential failure areas could be. But why is someone going to like it? Because again, it's infrastructure-led exploration. I've said that a few times tonight. It can be brought online very quickly. It's a lookalike to the Corrib field. It's a very attractive fiscal environment. It's arguably not as attractive operating environment because of the Irish government, which can be a little bit unstable. And that's the challenge that we've got, is to attract someone in to come into Ireland where historically it's been viewed as essentially not a hospitable operating environment. But it's a world-class play in a very attractive fiscal environment that can be brought online very quickly, putting gas into the European system. So that's going to attract, and it has attracted when we started the farm out process last year. It will attract some people. It's whether we can close it and get a good deal is our challenge, and hopefully we'll do that over the course of the next year.
Great, that's terrific. Will Holland, CEO at Europa Oil Gas, thank you so much for joining us tonight. Such an interesting company with lots of interesting prospects there. Okay, our third company of the evening is MicroSalt, and they are the low-sodium technology company currently commercialising a patented full-flavour low-sodium salt. MicroSalt became the first company to IPO in AIM this year with a very appropriate ticker, SALT, S-A-L-T. Shares were 43 pence at launch, and yes, really, they're now more than doubled in price to 90 pence. So some IPOs do go well. Excessive sodium intake is a major contributor to hypertension and heart disease globally. And CEO Rick Guiney and CFO Konrad Dawbrowski, they join us live from Florida to explain how they make it easy, or MicroSalt makes it easy for global food manufacturers to lower the amount of salt in processed food. Greetings, Rick and Konrad.
Thank you, Donald. We really appreciate being here. And yes, we are coming from sunny southern Florida. So yes, we are.
Yeah, sunny southern Florida.
That's right. That's right.
It's a joy and a pleasure to have you on, Rick and Konrad. So if you want to deliver your presentation, we'd be very happy to listen.
Let's go then. Okay. So let's just talk a little bit about what we're trying to do here, our company profile and our mission. We have patented technology that allows us to produce the world's only low sodium true salt. We're a major disruptor in the food market. And what this allows us to do, very simply put, is to deliver full flavor with low sodium. And that's significant different from the previous low sodium solutions. You know, sodium is a really big problem, and the problem is international. Every geography has its own issues. The WHO is targeting global reduction by 30%. All 194 WHO countries have signed on to that. Every single one of them. 7.6 million people in the UK have cardiovascular disease. In the UK, your target of consumption for sodium is 6 grams. That's your target. You're actually at 9, and the WHO says you should be at 3. So in the UK alone, sodium reduction is a significant and highly profiled issue. Some of you may have seen recently that Henry Dibbleby is trying to announce new food advertising and packaging controls with black octagon labels on the front and advertising restrictions at nighttime. So it's a significant problem. We're really happy to be able to say that we, through our new technology, can get there. The market is massive. We have patented technology that gets us there without changing flavor. And the real point there to this is that means we don't have to instigate consumer behavior changes. The consumer will never know. Your crisps in bag 1 versus your crisps in bag 2, bag 2 will taste just the same, except it'll have 50% less sodium. And that's the biggest thing. You can't maintain a low sodium diet if your food tastes bad. Our stuff works in a lot of applications. It works topically on crisps and nuts and crackers and popcorn. It works in slurries and formulas. It works inside peanut butter. It works in almost everything. It works really great in bread. It works excellent. And part of our process is what we do is we make it really small. And when you do that, you improve its product adhesion. You know, we've all done it. You shake your food, you put your salt in your food, and the salt bounces off, so you put more on. Well, MicroSalt doesn't bounce off. It sticks to where it's going. So when you ingest it, you get the full flavor without ingesting all that extra salt. And if you're on the production floor, you know, those of us that have spent some of our career on the production floor, you know, you've got salt everywhere. It bounces off. It's in the lines. It's on the floor. It's in the extra in the bags. None of that happens. It's really, really great on the production floor. And, you know, it tastes like salt because it is salt. We don't grind it. We don't mill it. We shrink it. And it works on any kind of salt, whether you're talking about mine salt from Texas or sea salt from Australia or pink salt from the Himalayan mountains. It all works the same. It's the same process. And, you know, that gives us a huge market opportunity. The low sodium market alone is over $5 billion. And that's not even counting the fact that we're now eating into the regular sodium salt market as a replacement. So we've got a great opportunity to address a serious health opportunity and a giant market. You know, our investment proposition is real simple. We have a unique technology. We deliver significant health benefits to everybody. You know, to the 12-year-old kid who doesn't have heart disease yet, maybe he won't get that heart disease. And to our grandparents and our parents that go to the doctor and come home with a low sodium diet prescription, then we can help them too. So we get everybody across the board. You know, rapid growth is our significant opportunity because it's everywhere in the world. You deal with a big problem like this, you deal with the biggest customers. We are dealing with the world's largest food manufacturers. They make food across the globe in different geographies. Now, of course, we talk to everybody of any size, but our target is with our bulk salt, and our target is those big players that make a lot of food across the globe. You know, our production is very simple. Part of the brilliance of this is its simplicity. We are able to replicate our production close to where the demand might be. We've had some customers say, can you make a plant in Mexico? We say, sure. Can you put a plant in Poland? We say, sure. Now, of course, there's volume requirements there, but it's not hard for us to replicate MicroSalt. We have the know-how, we have obviously the patent, and when we have all the trade knowledge from almost 5 years now of learning how to make it. We've got a great team behind us. We got a great board. I mean, this board is just fantastic. Konrad, who's sitting silently next to me here, is a really well-qualified international CFO. Judith Batchelor is an OBE. She's the highest-ranking British nutritionist, and she's extremely active in the British food scene. Gary Ormstrom is a very well-respected and experienced CFO at the largest level. And Dan Emery is an experienced high-level sales guy. And these people aren't an idle board. They are engaged with us. They're almost like sales reps. It's really great. I get emails from them all the time. Real quick on the market, on the right-hand side, you see some of the standard stuff, low salt, new salt, no salt, and they all basically come from potassium chloride, which is all the industry had before us. You see on the left where we are, we have 148 megagrams of sodium compared to Morton salt at 590. That's a significant health benefit. You're shaking salt on your food, you should be using MicroSalt. If you're making food in your plant, you should be using MicroSalt to save that kind of sodium consumption. Konrad, can you flip for me? Thank you. Okay, we basically have a three-pronged marketing approach. B2B is where the meat is. Obviously, that's where we sell the major food manufacturers, the salt resellers across the globe. We just returned from 5 days from the world's largest food show in Dubai. It's how we're going to address our problem. The problem we're addressing is sodium consumption. So this is how we're going to get there. We also, in the beginning, nobody believed us. Said, yeah, sure. So we went back and we made a line of proof of concept here in the U.S., potato chips. And they came out so great that there's in over 500 stores now. So we have some B2C business. We also thought it was important that since this is such a health benefit, that we put shakers in people's hands so they can put them in the pantry. They can become generational product. So we do have shakers for sale in the UK, specifically on Amazon.com, and in addition to the US. And of course, through all that, we have marketing support. Here's a quick look at our pipeline, our consumer pipeline. And it goes from right to left again. Consumer A and Consumer B have already placed their first orders. They are major international food companies. And I'm not allowed to say their names because of their own press release regulations internally to them. Customer C and Customer D, we're in testing and rollout stages. These are major international food companies. And the thing of it is here is that we're not asking anybody to create extra SKUs. We're not saying, hey, have a bag one of crisps and then bag two of low sodium crisps. We're not saying that. We're saying just change your salt. It saves all their time, all the marketing efforts around that. And it's a serious and significant benefit and a result of the new technology. We've got Customer A, we're on their private label nut line, and it's in over 900 stores. And we expected that to roll out during 2024. Customer B is the Mexican subsidiary of Customer C, again, an international company. And we're already commercialized with them. They've already given us multiple orders. We are in a number of items. We're extending ourselves into Latin America and South America through the Mexican doorway. Customer C is actually the headquarters of this particular company, and we have a number of products in discussion with them, and including a joint development agreement that's in conversation. We hope that's all going to wrap itself up first half of 2024. Customer D is one of the world's largest bakery companies, and we accelerated our products through their R&D because, again, it's so simple. We're not introducing new flavors. In the past, reformulation was a food nightmare because you were actually adding a new flavor. Right now, reformulation is easy. We're not adding a new flavor. We're just switching out salt. And customer E is one of the world's largest chicken producers. Specifically here in the U.S., they do a ton of business with the K through 12, lunch business, and they've got to lower sodium. Now, the sodium in chicken comes in the breading, obviously. When you make, who doesn't like chicken nuggets? There's salt in that breading. So that applies. That's how we get to that market, and that market applies again internationally. There's chicken nuggets everywhere. Again, I was in Dubai and I could get chicken nuggets. It's everywhere. Salt and sodium consumption is a global issue, and we have very few geographies that we don't have opportunity in.
Yeah, that's right, Rick. And as you mentioned, even just seeing customers A through E, they're mostly focused on the snacks, large food manufacturers that produce a line of snacks, whether it's crisps, popcorn, sometimes it's cereal, sometimes it's ready-to-go meals. So there's a wide application of that, of MicroSalt. And in the UK alone, the government has designated around 84 categories of food that should be targeting reducing sodium levels in them, and MicroSalt works on almost all of them. Each one of those products is a multi-million pounds opportunity for MicroSalt. And Rick, I just wanted to maybe mention here that while we current customers are mostly on snacks and food ingredient, we can also apply MicroSalt on bread, right? We recently filed a patent application a few months ago. Can you talk about that a little bit more?
Sure. We have the same functionality as traditional salt, and salt is a requirement to have bread and yeast develop in bread. And we found that MicroSalt does a better job of activating the yeast than traditional salt. So not only do you get a lower sodium bread, you get a bread that's made quicker. And this has been tested by one of the world's largest QSR chains, and they're very excited about it. And they're the ones that actually pointed it out to us. They ran MicroSalt through stress testing following our presentation, and they were extremely excited about how they can make bread quicker and they can make bread taste the same, but with much less sodium. Typically, there's over 200 milligrams of sodium in a standard hamburger bun. Imagine how many hamburger buns are made across the world, or just in the top three QSR chains.
That's another addressable market for us. And as we kind of move into the financial discussions, it's worth remembering that 2023 was really the year of launching MicroSalt for two of those largest B2B customers that Rick mentioned, customer A and customer B, and our revenue in 2023 only reflected the proof of concept sales. We've also launched MicroSalt shakers in 2023, so the numbers from those sales are also not annualized. That's why we're so optimistic about 2024 and what the future holds for us. Historically, we've invested into sales and marketing and obviously development of the product. As it comes to R&D, it's mostly complete when it comes to snacks and breaded product. Our business model is very friendly in that it focuses mostly on B2B customers with very good gross margins and doesn't involve necessarily huge amounts of money into branding and name recognition and brand recognition, right? It's not a B2C product. There is already a need and market existing for that. Around half of our customers and leads in our pipeline came to us directly on a cold approach basis. We didn't have to do much to get to that point, and obviously a lot of work when it comes to reformulation and working with their teams to roll out the product. But in terms of the sales job, it's that much easier when there's already government regulation and pressure and NGOs, as it is in the UK, for example, and coming regulations in terms of the front of package labeling, which also forces the companies to come to us. Another great thing about MicroSalt is it doesn't involve a lot of capital expenditures, because it can be produced in a manufacturer using already existing off-the-shelf dry spraying equipment. So any flavor house, seasoning house, any large food manufacturer doesn't need to alter their equipment or buy new equipment. Just to talk briefly about use of proceeds from our recent IPO, it's a good use of capital in terms of the growth capital, because we're focused on scaling up our inventory and how we can deliver to some of these largest customers we already have. We've had 7 people on the team, and Rick and the team need help in terms of just servicing the large orders. They're not contained to one geography either. We're working in Latin America and in North America, but also in Europe and Asia at this point. So it's a really good use of funds. It's mostly past R&D. Now we have future opportunities in terms of line extensions, for example, for French fries and other very large addressable markets. But most of the funds is really going towards the working capital and inventory. One good thing about salt is also that it has a great shelf life. So inventory management becomes that much easier. It's also easier to ship, and we can stock up in certain geographies. And Rick, back to you.
Thank you, Konrad. Excuse me, why? Yeah, what this boils down to, everybody, is we have a serious competitive advantage with our unique patented product. The market is huge because we deliver significant health benefits everywhere. We're allowed to grow across the globe, and that's an unusual thing. Both B2B and B2B channels are solid for us. We have high visibility and high profile customers. It's easy to make our stuff. Let's be honest. If it was really complicated, we couldn't say with a straight face, yeah, I can make it in Mexico, and yes, I can make it in Poland, but it's relatively easy for us to make. We're beyond a startup in the sense that our team is really strong, and we know how to do what we're doing. And we have a clear trajectory. We know exactly what we need to do. We're already embedded in some of these larger food companies, so we're ready to go. It's an unusually strong opportunity. And as you can see a picture over here on the right, sorry, this is Chef Jack Stein. He's our local UK ambassador right now, and Chef Jack is actually working on videos for us as we speak. If I can wrap it up, it's an unusual opportunity for us to come to work every day, to earn a return on investment, and to actually help people be healthier. And I say this anecdotally when I make sales presentations, but it's very true. I have a 15-year-old son, and it'd be great if he didn't have heart disease when he's 55. Mm-hmm. And that's really what we're talking about, is keeping people alive. Back to you, Donald.
Okay, Rick, thank you so much for your presentation. I'm slightly worried about your voice. Do you need to go and get yourself...
I'm sorry about that. I've been using it a lot lately.
Crisps, Rick?
I've been using it a lot lately, and sorry about that. I apologize.
Do you have any access to water, Rick?
I do. I can get a little better here.
You go grab yourself some water, I think. And in the meanwhile, I will ask you a question. American Trading International, you just put out an RNS reach on the collaboration you're doing with American Trading International. So if you could explain who ATI are and what this collaboration will look like and what other collaborations in the future might look like. Is this the first of many?
Yes, it's fantastic. I just spent a week in Dubai with ATI, American Trading International. And what happens is they acquire the booth space that we need, let's say in these foreign markets, in this case Dubai, a very large footprint. We then have a space within their booths that alleviates us from having to ship international booth expenses. And when customers come to buy American products from ATI, let's say again in Dubai, we are now included in that list. So as we stand in the booth with the ATI personnel, we get to extend ourselves. It's an invaluable asset when you're entering international markets. These food shows in Dubai and in Shanghai and in Paris, just to name a few, are massive events. So if you're a standalone item, it's very difficult to make any progress. By partnering with ATI, we are now part of their product family for export. So you need to fill the container up. Let's be real, you're filling up a container. Now we can do it with 20 items instead of just our one. So it really, really expedites the product flow. It makes it cheaper for everybody. And it's a fast track way for us this year to make significant international presence. You've got to meet people, And I always believe that people do business with people they like. So that means we're going to stand in that booth, and we're going to be in Shanghai, we're going to be in Dubai, and we're going to be in Paris, so that people understand who they're doing business with.
Yeah, that's absolutely fascinating. It does sound a great way to do business. You were mentioning customers A, B, C, D, E. At what point in the sales cycle will you start to be able to tell us who those customers are? When will you be able to start booking sales? And when will that start feeding through to the bottom line?
Well, we are booking sales for some of them now, but part of our relationship is that we have to protect their own internal procedures, policies as it regards to their supply chain. We do expect some announcements relatively soon. I can't tell you exactly when, because that's a cooperative venture between us and our customers. And there are some issues. There are some competitive advantage issues. There are some other issues involved in their own PR, their press release and communication standards. So we're frustrated as well as you. We'd love to be able to tell you who we're talking about, but we just can't just yet. But as long as they continue to deliver us the orders, we'll survive.
That's the thing about dealing with the world's majors. They call the
Yes.
shots, and you don't, unfortunately.
That's correct.
Yeah. If you could talk us through a typical sales cycle, given that that's where we're at, is there such a thing? And presumably it's a lengthy process winning a brand's trust.
Well, yes, it is. But we have a couple things that are working for us. First, we're not asking them to create new SKUs. We're just asking them to reformulate their current business, so that the marketing spend is much less than it would be. We have significant tailwinds behind us with all the government push to lower sodium. The consumers want lower sodium, so we have a lot of tailwinds to help shorten the sales cycle. Typically, without all that stuff, it'd probably be 18 months. But we've been able to shorten it significantly because we have these things, these advantages. Most of the major food marketing companies already have existing low sodium initiatives in-house. So we dovetail with that stuff really easily we don't have to convince these people that they need to lower sodium. They know they need to lower sodium. It's just a matter of how.
Okay, which takes us to a question from Tom Dunley, a shareholder. He asks, when should investors expect to see a financial calendar disclosing revenues, EBITDA, and so on for the business? I was having a chat before with Konrad, and he says it's perhaps a little bit too early, but there you go.
Yes, at some point later in the year, yes. We're still aligning, with some stakeholders in terms of the calendar of certain activities and our financials, as we're doing it for the first time after the IPO. So, but we'll keep you posted, and we'll update the market accordingly.
Okay, thank you very much, Konrad. Yes, the health benefits of a patented low-sodium product give you big advantages in some markets. So which countries and governments are keen on reducing salt from people's diet? And how are, in particular, relationships with the UK retailers progressing? I'm sure quite a few shareholders are actually in the UK, so they'll be interested to see some successes, some wins with the UK retailers.
Well, the UK is one of our target markets. Obviously, we're on the London Stock Exchange, so the UK is one of our target markets. And we are making significant progress with all of the UK major chains. Again, I can't say them by name, but there aren't that many, so you can pretty much put your names around it.
We're working them out.
We're talking with them. We're talking to all their suppliers with their support. And basically what happens is we get on a joint sales call with the retail on one side and their co-manufacturers on the other, and we're in the middle. So there's a three-way conversation. It's not just us trying to convince the manufacturer to do it. We have the stakeholder in that conversation. And that's how that starts. And then we go off to the reformulation stage. We are down the road with a number of products and with a number of retailers. We're very happy that you can buy the shakers in Amazon UK as we speak now. And as we continue to grow, it's only going to become more and more obvious.
Okay, let me ask you, what are the toughest preconceptions you have to overcome when you're speaking to those global manufacturers? When you're standing in that stand in Dubai, what are the tough questions they're asking you?
Well, it's all about reformulation. And it's a really simple answer. It's just new technology. In the past, the food business has been saddled with a very difficult task of reformulation when it comes to low sodium because they were actually adding a new flavor. Potassium chloride has its own flavor. So reformulation became very complicated. In our case, reformulation is extremely easy. So we say it's like the dial-up modem. It's like seat belts. This is the next level. And reformulation has become so much easier. Take out your existing salt product and put in MicroSalt. We're not asking you to hide a new flavor. We're not asking you to do any of that stuff anymore. It's just a simple replacement. Now, they're going to want to run their tests, and I appreciate that. It's their job, and they want to protect the public and make sure that their products taste the way they want to taste, and that's part of the sales cycle. That's part of the food business. But we have significantly streamlined the reformulation progress, and that's been the problem. And when people realize that, then they say, "Oh, I don't have to do any of that work. I don't have to balance flavors. I don't have to add in 5 to cover up 1." No, you don't. It's very simple.
Is this where if I could ask, Rick, is this where your experience huge experience in the food industry comes into play? I mean, you've actually been a CEO of a business and made these decisions for yourself. So are you the secret weapon, perhaps? Is that a good way of putting it?
No, I'm not the secret weapon. The product is the secret weapon, for sure. The product and the team are the secret weapon. But I do have experience in this a lot. And I remember in my previous life struggling with wasabi. When wasabi first came on the food market, it was a big hit. And I struggled with wasabi because it's really strong. And if you're going to add wasabi, you have to add something else to cut it back a little bit. So I'm very familiar with this whole reformulation, oh my gosh, it's a nightmare kind of thing. And it doesn't have to be that way. And once you get the R&D departments understanding that, they can fast track this all the way through right up to the C-suite, in a matter of weeks.
Yeah, I think overcoming these, in a way, preconceived notions of, well, if something is low sodium, then it has to taste worse, right? That's the kind of expectation that grew because that was what was available in the last 20 years. The UK government has been trying to lower sodium, has set out multiple sodium reduction targets in the last 20 years. Even from talking to the bachelor, OBE, she's on our board, the market has been just waiting for an ingredient that doesn't sacrifice the flavor. And so once we demonstrate it in extensive testing with customers, that obviously comes out that we can do that. But, sometimes initially that's the approach, right? If it's lightly salted, that means it doesn't taste as good, right?
Okay, my final question to you, Rick. What news flow can investors expect over the next 6 months? And why should investors add salt to the watch list now? There you go, big question to end on.
Well, I'm going to pick that most of the Konrad, but I'll say, being the sales guy, you'll see nothing but good news from us. But Konrad, what do you have to say about that?
Yeah, I think in addition to what Rick kind of alluded to your previous question, Donald, in terms of some of these large customers, they all have their internal low sodium initiative, and what they usually do is they come out, hey, here's our press release, we're trying to lower sodium. And then they have a series of press releases when they get more granular and they say, okay, in this XYZ product or product line, we've launched lower sodium. So we're kind of at the mercy of their calendar because at the end of the day, we're their supplier. So we do expect some news from these large customers this year. And in addition to that, that's on the B2B side, wholesale side. And then on the B2C side, we do expect also some retailers in terms of the shakers and the crisps perhaps, but more so focused on the shakers in the UK and abroad as well. It could be a combination of e-commerce platforms and physical stores and retailers, but that's our go-to-market effort at the moment.
Okay, gentlemen, thank you so much for joining us from Florida. That was Rick Guiney, the CEO at MicroSalt, and Konrad Dawbrowski, the CFO at MicroSalt. Thank you so much. Have a good evening, gentlemen. And our final guest this evening is Gaius King, a resource analyst from Fox-Davies Capital. Tonight, Gaius addresses the uranium market, where market data shows that the output is only or just 72% of demand. Nuclear power is attractive because it's a green energy with baseload potential. Citibank say they expect uranium prices to average $110 a pound in 2025. Others expect prices to go as high as $150 a pound. Gaius King believes the data also shows there may be a short-term twist in that longer-term uranium bull market tail. Welcome, Gaius.
Thank you, Donald. Appreciate the opportunity. And hopefully you can see my screen.
We can see your screen. Thank you very much indeed for joining us tonight, Gaius. Do you want to deliver your presentation?
Absolutely. Thank you. Look, I apologise up front. This is going to be a very short, myopic view of the world. I'm primarily focusing on secondary shortages and why they're important, and not looking at demand at all, but hopefully it'll give a flavour of why I think uranium is a very exciting area to be in. What are critical commodities? Well, obviously uranium is one of them. And I know I've put this up before previously, but look, if it's not growing, it's mined. And mining may not be fashionable at the moment, and it's not ESG, but it is the basis of every modern economy. So if we look at the next page, figure 1, and as you can see with that graph, the uranium price has jumped 100% in the last 12 months, which is very good. If we turn the page again, Figure 2 shows that, but what we've plotted is the short-term price versus the long-term price. We would merely make the point that the short-term price, yes, that's jumped 100%, but the long-term price has only jumped 34%, and it sits 40% below the short-term price. The short-term price obviously is driven by more trading, and in particular, a certain Sprott uranium trust. But that's not to say that uranium is not in grand shortage, and we think it has a long way to run. Also, just to highlight what Donald just said there, even if we have a short-term uranium correction, and let's say that short-term price drops to where the long-term price is at the moment, do not abandon this sector because there are fundamental reasons why you want to stay in. So if we look at figure 3 at the next page, we've plotted here uranium global consumption of uranium, and we make the point that it's been basically steady for 2 decades. That's despite Fukushima. And down the bottom there in red, that's the emergence of China and its nuclear industry. It's the second largest in the world now. If we turn the page again, please. And these are 2 graphs that just demonstrate that. So obviously the figure 4 shows the US, China, France and Russia as being the top 4 nuclear countries. But figure 5 shows that France uses or generates 63% of its domestic electricity via nuclear power, and unsurprisingly has the cheapest power prices in the EU. If we turn the page and look at figure 6, and this is the crux of, I guess, this whole thesis of why uranium is very exciting. I was there in the original uranium boom in 05, 07, great times in Western Australia, great companies, very exciting. I think this uranium coming up is far more fundamentally based. And what we have here in the grey in the blue is consumption. What we have here in the grey is what we mine. And at the moment, we're only mining 72% of what we consume. The remaining 28% are coming from secondary resources. Why is that important? We turn the page to figure 7. In the past 2 decades, the uranium supply story is a Kazakhstan story. The Kazakhstan is that dark grey on top. It supplies about 40% of the world's uranium. Without Kazakhstan, global uranium consumption would have declined. I think Kazakhstan produced about 22,000 tonne per annum, and it peaked about 2016 at about 25,000 tonne. But without it, we would be far shorter in uranium than we otherwise would be. If we go to turn the page to figure 8, most of that's in situ leach. That's Kazakhstan and other places, and the rest is open pit. The largest resources in the world are Australia, but that's deceiving. And most of that can't be accessed. the largest second lot of resources in Kazakhstan, Canada, and Russia. If we turn the page, please, to figure 10 and 11, and this is how concentrated the industry is. 90% of global uranium production are from 10 companies. 2/3 of global uranium production are from Russia and its associates, whether that be Uzbekistan, Kazakhstan, Niger. And obviously, figure 11 just demonstrates where Kazakhstan really does play a major role, and then there's the rest. If we turn the page, please, to figure 12 and 13. So this talks about enrichment and primary conversion, let's say, into pellets to use into nuclear power plants. And yes, Russia plays a part, but there's also the UK and the US and whatever. But the point we would make is that it's pointless having conversion capacity if you don't own the primary production. And it's the argument we've used in other commodities with China, whether that be lithium or rare earths or whatever. China controls the primary supply and enrichment to that area, and they control the EV market. Well, we're saying the same is happening with Russia. So yes, enrichment capacity and fabrication does occur in other countries, but Russia controls the primary supply. Next page, please. And we'd also argue that actually mining cost is irrelevant. This is a cost curve, the most recent I got from Kazatomprom. It's a Kazakhstan producer. The vast majority of global uranium production is below $20 a pound. Now, the current price, spot price, is 100. So obviously, the price is not a large determined on supply coming online. You have to keep that in mind. That, and we'll return to it later, that uranium is geologically and geographically constrained. And it's the same with a lot of commodities. If you're looking for copper, you look in South America and maybe the Ring of Fire. Uranium only occurs in certain places. If we go to the next page, please. And this is the graph. So in figure 15, obviously you see Australia, there's a large amount of uranium. But the problem with uranium in Australia is the vast majority of, in fact, the vast majority of the world's reserves occur in one deposit. It's called Olympic Dam. 75% of its revenues are from copper, only 20% are from uranium. Any expansion going into Olympic Dam is unlikely to be done on the uranium price. So if you, and the other parts of Australia, there are great deposits in Western Australia and also in Queensland, but you can't mine those. The only places you can mine in Australia are the Northern Territory and South Australia. So Australia is sort of off limits, really. I mean, there's Boss Energy and a few others, but not great. So the two other big areas of interest you really want to look at is Canada and Kazakhstan. You can jump to the next slide, please. And this is also an important concept. It's probably intuitive, but I'll just highlight it because it's, I suppose, simple. When you're looking at coal-fired power or a gas turbine, the vast majority of the cost of generating the power of energy is from the commodity itself. In uranium, it's not, because there's a large amount of upfront capex. So at the end of the day, only 14% of the cost of power from a uranium plant is actually from the uranium price. So it's relatively inelastic, given that all the other cost inputs are relatively fixed. If we can go to figure 17. Now, Donald questioned why I kept this diagram in, but just basically to highlight the point that actually this industry is highly regulated, highly and vertically integrated. You can't break into it. You have to either be of two spheres, the Western or the Eastern sphere. Go to the next page, please. So, just to highlight a couple of points out of this diagram, peak mining for uranium occurred in 1980. From the start of uranium mining up to 1980, the vast majority of uranium went into bombs, after which it went into nuclear power stations. A lot of the bomb material that went from Russia, from the tons to megatons program, which is still ongoing, it's been extended 3 or 4 times, still occurs. If we go to the next page, please. Why is that important? Because we roughly know how much uranium has been mined historically, tonnage and grade and recoveries. That is the blue line. We also roughly know how much uranium we have used. So if we're saying we're only mining 72% of the uranium we're using and 28% of that is secondary supplies, the question then becomes how many or how much of secondary supplies do we have? And the gap between the blue and the red line is that. And that number is 525,000 tonne of uranium. Can we go to the next page, please? So a big warning on these numbers here. These are my numbers, they're not anyone else's, given I couldn't find anyone else's numbers pretty much anywhere else. So they are invariably wrong, but I had to give it a go. So I went around to different sources around the world, just tried finding where these inventories are, how much, and in particular Japan. Japan's been accumulating a lot of uranium. I think it's hidden at least 50,000 tonne. It's off the books, but, you know, we can't go there. They're probably going to use it for something else. So if we go to the next page, please. Table 1. Okay, so these are the sources and where I got the tonnages from. And if we take it as gifted that there are 525,000, that's the maximum limit of secondary resources we have. We know that we consumed last year 19,000 tonne of uranium in secondary resources, and that gap is increasing every year. You just divide one into the other. Oh, and also what I did, I said, okay, let's say that we don't have the 100% of missing resources, that we have 80%. The numbers come up that suggest that we have somewhere between 11 and 6 years of secondary resources of uranium left. Sounds all right. Go to the next page, please. But, this is the big but. If you then say, okay, well, China and India control a substantial amount of those resources, and the US is quite well supplied with its own inventories, which you can look up and find out, it suggests that there's some Western European utilities have somewhere between 2 and 3 years of supply left, which is nothing, given that a nuclear power plant has to be refueled every 18 to 24 months. So these shortages that are coming are very real, and the impact could be literally catastrophic. Can we go to the next page, please? So this is just an example, Lazard's, I think it's 16th generation. Now the diagrams are quite common and they're quite complicated, and it's called a levelized cost of power. This is based in the US. And what this diagram is saying, if you look down to where nuclear is, sorry, it's a little bit fuzzy, I apologise for that, it suggests that the average cost for a nuclear power plant is somewhere between $140 and $220 per megawatt hour. And then if you look at wind onshore, it's half that, and solar is even less than that. And you think, well, why would anyone concentrate on old technology and build nuclear power when all these new generation renewable energies are just so much cheaper? And then I would draw you to one tiny little yellow dot on the nuclear thing that says $31. What does that yellow $31 mean? So if we go to the next page, please. And this is it. This is the cost of nuclear power in the US over the past 2 decades. In the last one I could find is 2021. It was $29 per megawatt hour. That's what it cost to generate in the US. Now, give an example. In December last year, the average cost in the UK was $102 per megawatt hour. So what I'm saying is that actually the US nuclear power industry is producing power at a third of the cost of what we're buying it for here in the UK. And if you're thinking you're going to run a modern economy economically against a multitude of manufacturing prowess out of China and services prowess coming out of India very, very soon, then you're behind the 8 ball if you can't afford to heat and warm buildings. Next page, please. So what we've done, and this is a work we've done behind the scenes, and I haven't bothered to put the data here because I just want to give you some of the results we've done. So what we did then is, okay, some of these costs look completely wacky. We will regenerate these costs, these levelized costs, because you don't know what assumptions they're using. I suspect I know what they've done, but I can't prove it. So Hinkley C is this nuclear power plant that's being built in the UK. It has the ignominy of being the most expensive, delayed, most contrived project in around. And then you have the Dogger Bank, which is the world's largest wind turbine. Now, they're both in the UK. They're both being built at the same time. Both have the same influences, labour costs, etc. Very good comparison. To cut a long story short, it appears that Hinkley C, the much derided Hinkley C, will produce power at half the cost of offshore wind turbines. That is not supposed to happen. but that is a fact. So what we did then, next page, sorry, what we did then is that we compared Hinkley C to a existing tracked solar battery, well, we added the battery component, a tracked plant out of northern Western Australia. And we put in a whole lot of unrealistic assumptions, including no transmission losses. We used 2 days in the middle of summer in January and February, and cloudless, and it could generate for 12 hours the track, the whatever. We used the battery cost from Vistra Moss, which is the world's largest battery project. They've just done a 3rd grade upgrade, so we know those capex costs very well. They did an upgrade of Northam last year, so we know those capex costs, and we obviously know Hinkley C. So there's a whole lot of work behind this. But using a theoretical the solar battery component and unrealistic operating parameters, Hinkley C would still be 20% cheaper. And in reality, it's probably going to be 50% cheaper again. So if we go to the next page, please. We've also released some interesting research on EVs. And we'd make the point there's no such thing as an EV. There's maybe a solar-powered car or a coal-fired power electric car or a gas-fired power electric car. Putting aside that some of the research out of Cornell is suggesting that actually natural gas produces more greenhouse gases than coal, we look primarily focused on electric vehicles generation out of China. If we can go to the next page, please. The results are this. A diesel Mini, 1.3 litre diesel Mini in the UK produces 60% less CO2 than an electric car out of China using a leaf analogue. And even a petrol car out of in the UK produces about 30% less than an electric car out of China. In fact, if you look down the bottom of this table, it's 0.173. That's what we calculated electric car in China would generate. And if you look at a whole lot of other bunch of cars, these are official data from the UK. Actually, a lot of these vehicles in the UK don't produce that much more CO2 than an electric car out of China. So really, the generation component of the electric car is important. We go to the next page, please. And then we go to Volvo. Volvo are the first OEM that compared the same model of car that they generate, and they compared it with what it would take to break even with the CO2 contents. And they found that it takes roughly about 110,000 kilometres for an electric car to break even with a normal internal combustion engine. In the EU, if you did that same calculation, it's about 77,000 kilometres, because the EU has a lot more renewables and a lot more nuclear power. If you look at just run an electric car off a wind turbine, because electric cars require more graphite, nickel from Indonesia, rare earths, and a bunch of lithium, whatever, they require a lot more energy to create. So it takes a lot more CO2 to break even. Can we go to the next page, please? Sorry for rushing through this, but I was warned not to overrun. But we just reiterate, and we've shown this diagram before, there is no such thing as a low energy rich country. So pennies snitching everywhere and turning off lights and whatever does not boost the GDP growth of a country. You need to have cheap base load power that you can readily utilise, and that includes the UK. So we go to the next page, please. So what have we covered in this incredibly fast, brief summary? Uranium prices up 100% in the last 12 months, but it could suffer a short-term correction. Uranium demand has been incredibly stable. We have totally ignored, eschewed other analysts' claims that uranium demand is actually going to increase dramatically. I would just say, where's that uranium coming from? At the moment, as of last year, our calculations are our calculations, not other people's. Our calculations suggest that only 72% of current demand is being supplied by primary, the rest is from secondary resources. The biggest swing producers, Kazakhstan, they can bring on ISL projects. I think in their IPO document, I can't remember exactly, that about 50 deposits. ISL you can bring on fairly quickly, but they cut their production for some reason. So there's a lot of geopolitical playing going on there. Remind that uranium is geographically and geologically constrained. You can't find it everywhere. It's quite rare. and remind that the USSR did not have much uranium, and most of the Russian bombs actually came from East Germany, Saxony, and they mined them out. So all the Russian bombs that you see today are mostly German uranium. Secondary supplies are critical, and in fact, we would go as far to say that we think Sprott and Yellowcake will be nationalised. If you do that at current consumption levels, that gives us an extra 2.5 years. Go to the next page, please. We would suggest that a number of Western utilities only have 2 to 5 years of supply. The uranium industry is very vertically integrated. Some of the published costs on uranium are, I think, wrong, or at least we don't know what assumptions they're using. We think they're cheap. The IEA suggests that the average long-term cost for uranium is about $60 per megawatt hour. We think they're cheaper, 50% cheaper than wind turbines, offshore wind turbines, and at least 20% cheaper than solar battery combinations. Next page, please. So nuclear power is green. So fundamentally, from an analyst's point of view, what does that mean we should look at? Well, you need to look at existing resources near existing, I guess, infrastructure in places where they mine uranium. Australia, Namibia, Canada, and the US are obvious targets, given that's in our sphere of influence and investment. Kazakhstan and Uzbekistan are great places for uranium geologically, but maybe not necessarily investment-wise. And I would eschew larger, lower-grade deposits until the uranium price runs very hard. I think they would take longer to get in production. There's more risk associated with that. So you really want to target higher grade, lower capex, quick into production. And when you do all those overlays on top of each other and you rule out all different deposits and whatever in the world, and this is from a guy who was pushing uranium projects in Australia and in Africa in 05 to 07, I think this time around when the uranium boom is going to really kick off in a real way, it's going to be Canadian Athabasca Basin projects that you want to look at, and also other projects that geologists are pushing the envelope. Next page, please, which is the last page. I've had a look at a couple of good projects lately. Obviously, this is not an exhaustive list, and I apologise to any company that didn't quite make this list. There's just a few guys I pulled off the top of my head that are interesting. Most of them have Canadian focus. Yeah, that's it. Hopefully I kept it within my 20 minutes time frame. I'm not sure.
Okay, guys, don't worry about your time frame. Thank you very much. That was very interesting. Very thought-provoking as ever. So let me kick off with, you expect a short-term dip in the uranium price. So what's causing that short-term dip if demand is strong and output is weak?
Look, and I've just been, obviously I have a watch list of uranium companies. I'll just point out in the last 3 months, Cameco, despite a good production report, increased future production. I know they've forward sold a lot of their production going forward, etc. The last 3 months, price has gone down 20%. If you look at Denison, good story. Their share price has gone down 12% in the last 3 months. So the market is telling you that something is coming. Also, I'd just point out that a lot of the, and it feels like a lot of the, sorry, can you see me, or am I supposed to just...
Yeah, you just get to answer my questions now, Gaius. I get to ask you questions now for the next 10 minutes.
Okay, apologise. Yeah, look, so in the back of my mind, I think the uranium price has been pushed up artificially because of Sprott's aggressive buying tactics. But it's not to take away that this is not a fundamental boom and it is going to go a lot higher. So I would expect if the spot prices, I think when I last looked, were 102, I would expect it in the short to medium term to drop into the 70s, but then take off again.
Okay. Over the past year or two, we've been hearing from several TSX listed and NASDAQ listed operators, uranium operators, on our various webinars, and they've been taking their uranium leaching projects out of mothballs and quite quickly going into production again. So I was quite surprised that ISL leaching numbers are down. Is it a possibility of too much supply coming onto the market quickly?
Well, the shortfall at the moment is 19,000, I think, last year, and it'll probably be higher this year, 1,000 tonne of uranium. I mean, you have Boss Energy, which is a project, I think it was called Honeymoon Well about 10 or 15 years ago. I can't remember. That's coming into production now. You know, you have Peninsula Energy, I think, is in the US. That's interesting. I think they're swapping from an alcohol leach to an acid leach, so that should increase their recoveries massively. But they will barely touch that deficit, which is growing. Secondly, not only is the deficit growing, let's say if these other analysts, they're probably far more clever than I am, are correct in saying that there are all these other nuclear power plants coming online very quickly, and demand's going to grow. My argument would be, well, where is the uranium coming from? And I guess the big story then is Kazakhstan. What is Kazakhstan going to do? They say they have all these resources, but I know for a lot of their deposits, they haven't worked on them for over 10 years. So, and they're mining their best deposits now, and obviously the second generation deposits are going to be less attractive. So I think the world is going to have to rely on Kazakhstan a lot. There is not a lot other than Rossing South and a bunch of other associated deposits there. There hasn't been a lot of major discoveries made in uranium. And mind you, there hasn't been much uranium exploration done either. So no, I don't think it'll even touch the sides. We're talking minutiae amounts of tonnage coming online. And it will be more expensive and it will take far longer. And we're talking about here and now.
Okay, guys, you were very clear. You said secondary demand was the critical determinant. Can you explain a little bit more about what you meant by the critical determinant? Talk us through the secondary market.
Okay, so secondary supply. So secondary supply, when we talk about secondary supply, we're talking about bombs. So whether it be Russia decommissioning whole bombs and doing from megatons to megawatts. The original deal, I think, went for about 10 years and then it's been extended 2 or 3 times since. So at one stage, I'm not sure what the proportion is now, but at one stage, 10% of all the US electricity generation was primarily on Russian bombs. And the Russians obviously spent a lot of money mining that decades and decades ago, and obviously it's very enriched, so they have to de-enrich it. It was a good program. I think less nuclear weapons is always a good idea. So that's one source. You have then companies like Sprott and Yellowcake who are taking Yellowcake and storing it. That's another secondary resource. And also you have secondary processing. So obviously when you run fuel through a plant, it denigrates from 238 to 235 and other daughter products. I think there are 32 daughter products in uranium. And then you can reprocess it, make pellets again and rerun it. So secondary resources are anything other than primary mining, but they're very limited.
Okay, and I suspect a question that we're all thinking, to what extent does Western energy security become a factor with nuclear processing and mining, given that Kazakhstan, as you say, is the swing producer?
Well, that's the interesting thing. And look, this is a question we started asking in the middle of last year. If what we think there is going to be another uranium boom, where do you want to go and what companies do you want to buy? And so you start overlaying different investment narratives and fields. And the idea actually, my experience, several decades of experience is telling me, it's not necessarily telling you what companies to buy, it tells you what companies not to buy. And so it sort of came to me that really, given the extreme negativism towards the nuclear industry in general, you want to go to a place where you can actually mine it. They're usually high grade, small, high cash flows, existing infrastructure, so you don't have to worry about processing plants and the whole works. I mean, there are 2 processing plants in the Athabasca Basin that you can toll treat through. So it just occurred to me that that's probably the best area. And then I started looking at the companies in that region. There's some really good companies. I mean, Atha Energy Corp, which I'd never heard of before, the guys there spent 10 years acquiring a massive land package that no one wanted. No one wanted to know the uranium, and then came to market. And that's what you want to find. You want to find these guys who've experts in the area, or I can't remember. There was I think it was Forum Energy. I think it was Rebecca. She worked for Cameco and then she did a PhD. Obviously lost her job, did a PhD. She's got a theory about another basin, and there's actually another deposit along line, and that's where mining is almost like biotech. Mining is very much a scientific endeavor. You go out with a specific geological model, you test that geological model, it's a fail or prove, or you adjust, and then you go out again. So there is opportunity, I think, and on personal, look, there's something else about mining.
I'm going to jump in, ask you my final question.
Final question.
So, if nuclear power is as cost effective as your analysis indicates, why doesn't Britain develop more nuclear power? There's a straight question for you.
And it's not so straight. So I was writing about this when I was working for a different shop. I was writing about this 15 years ago. And I was predicting, typical analyst, waving my hand saying, look, the UK is going to hit a cliff, an energy cliff. But what I didn't see then was the rise of renewables. So actually wind turbines and some solar and additional gas has really pushed that cliff out for the UK a long, long way, probably a decade longer than I was expecting. But that cliff will arrive. And those renewables and all the promises and the costs associated with those renewables are not going to come true. They are a lot more expensive. The battery technology doesn't exist. It's not cost effective. It burns. Alta Vista had 3 fires last year. So nuclear power is needed, but there is just so much angst against it. And hence the reason why they're pushing these SMRs, small modular reactors. That's just an excuse not to invest into existing nuclear technology. And I've written on that recently too, but yeah.
You're not a fan of SMRs, Gaius?
I think no, look, there are needs for it, but as far as I'm aware, there's only 2 SMRs globally. There's one in China that was experimental, and then the Russians. The Russians are a long way ahead. And SMRs are effectively a nuclear module, a bit like there's 160 ships floating around on Earth with nuclear reactors, most of them submarines, 200-odd reactors. Some of the big aircraft carriers have 2. They're very expensive, and they have to be incredibly well monitored. They have to have very specially trained people. So when people say, oh, we'll just build an SMR and we can put it all over the UK and whatever, no, you won't be able to, because the same legislative framework, and this is what we went into in a great way, the same legislative framework that you do for a conventional nuclear plant, you have to do for an SMR. And then it comes out in the US, some of the preliminary costs. SMRs are not even that cheap. So what we're saying is that a conventional nuclear power plant is 50% cheaper than an offshore wind turbine, but an SMR is only 20% cheaper than an offshore wind turbine. They're substantially more expensive. So we think now that SMRs will be used in conjunction with existing area sites of nuclear power plants, which makes sense because you have approvals and whatever, and it'll be done very, very quickly. But SMRs, I think, is a little bit more hype than fact.
Okay, brilliant. Gaius King, resources...
And again, where did he get the...
You're a star. Thank you very much indeed for joining us tonight, Gaius. That's Gaius King, a resource analyst from Fox-Davies Capital. Thank you to all our speakers for joining us live from around the world. And likewise, many thanks to everyone who helped organise the evening and who got us here in one piece. That's it from us. A huge thanks to you all once again for being such a great audience. And we look forward to seeing you again on April the 9th. Have a great evening, and don't forget to share your thoughts on sovereign metals, Europa Oil Gas and MicroSalt on the London South East Bulletin Board. That's it from us. Thank you so much for joining us tonight.